Hello,
Hello,
the Sonia and Richard show.
we're back.
Yes, excited, ready
Yep,
to go.
yep. So we are on season 2, episode 6.
Five,
5, sorry.
five. I
um,
know keeping track is interesting.
yeah. So today we're going to speak about simple inheritance tax busting actions.
Yes,
So what is that, Richard?
that's a right question. But to narrow it down, just simple things that anyone can do who may have a potential inheritance tax challenge. Just simple things that can be done to, bust any potential inheritance tax issues, or at least reduce it to some degree, without having to do a huge amount of work, or fork out tons of money or whatever it might be to rectify the action,
Okay.
or to provide a solution, shall we say.
Yeah.
So it's just something that anyone can utilize quite simply. Obviously, we're not giving advice on this session. It's just to give ideas, give thoughts, pique interest. And if there's anything that interests you, then obviously reach out to us or your advisor to have more of a conversation around that. Definitely.
Thank you. So we're going to start off with the different types of ways that what people do to reduce their inheritance tax. So the first one is tenancy in common. Would you like to expand on that a little bit, please?
Yeah. So just to clarify, tenancy in common on its own is not an inheritance tax busting solution, but it does go a long way to help towards that. So most people own their property if it's a couple, in joint names, which means that they own it 100% equally, especially the mortgage side of things. Or some couples, maybe one person owns it, but two people live there. And the second person does contribute, or maybe you pay towards a deposit or whatnot, but they just don't want to be overtly involved, or they got married later in life and moved in, and then they contribute towards a home, and the other spouse wants to add them to the property, but they're not there. But just to get back to the point, a joint tenancy is where you own it 100% each. Now the challenge is if someone passes away and it's in joint names, that means that 100% of the ownership by succession goes to the surviving party.
Yeah.
Now, from an estate planning point of view, that's an absolute nightmare. For inheritance tax planning, it can allow you to make certain gifts strategically, especially for married couples. So we always say, both from an estate planning point of view and from an inheritance tax point of view, definitely advantages of using tenancy in common. But everyone's situation is different. There's some scenarios where actually leaving it in joint tenancies could actually work out much better, but that's really strategic planning. So it's not a blanket statement, but it's something it's worth considering, and entertaining, again, with a professional to give you more guidance. So definitely something to explore.
Thank you. So how would getting married kind of fit in the equation of this?
Well, maybe I can answer that question with a client scenario. Actually, one client recently, well, quite a few, but the one I'm thinking about. So we call them Gerard and Julie. Apologies if your name is Gerard or Julie. So Gerard has a son from a previous relationship. Gerard's inherited a property from his mother, his late mother, and that property is rented out. And Gerard has a partner, they're not married, and they own that property together. Now, and so Gerard's wealth on his own, let's say it's about £800,000. Okay. Now, if Gerard passes away, if he passed away yesterday, the house that he owns jointly with his partner, because he's not married, because it's in joint names, 100% of that would go to the joint owner, Julie.
Yeah.
Julie does not have children, but Gerard does. Now, potentially, Julie could say, "Well, forget Gerard's son. Never liked him in the first place. He ain't getting anything from me," and that's a potential disinheritance. Yeah, will or no will. If it's not done properly, that's a potential disinheritance. Also, inheritance tax is due because they're not married. will be due on Gerard's immediate death, 6 months within 6 months of him passing away. And Gerard his wealth is £800,000. Now, you could say some of that's gone to Julie because she owns a house outright in her own name, but the assets, even outside of the home, still exceeds £500,000, just for argument's sake. And there's going to be some inheritance tax due. So Julie has to sort that out some way, shape, or form, because ultimately it's going to affect her one way, shape, or form. And it could be prevented or delayed if they just got married. Now, if they just got married, and if they separate the tenancies, so let's focus on separating the tenancies. If they separate the tenancies, the tenants in common, Gerard now has control of his half.
Yeah.
His will can then direct it to his son. So Julie would have the right to stay in the property for as long as she's alive. And then when a death event takes place, Gerard's half of his assets goes to his son, because that's his first priority, and he'd want that. So that works out. In the will, well, I'm going to go too far ahead in the example. We can bring up some other points maybe later on. But ultimately, with that situation on its own, just by splitting it to tenants in common, it could be a potential inheritance tax advantage. It'd be ironclad if they got married. If they got married and done tenants in common, that would be, say, an ironclad scenario for inheritance tax busting tips, because rather than paying inheritance tax on Gerard's death, if they got married first, number one, spouses can gift to each other unlimited, so they're exempt.
Yeah.
So we can draft a will to take advantage of that. Spouses can also pass their allowances. So providing that Gerard didn't make any gifts in his lifetime within the last 7 years, he can transfer 100% of his allowance to Julie, because they're married now. So Julie would have £1 million to play with as an allowance for inheritance tax. Plus, Julie does not have any children, but as soon as she gets married, she formally has a stepson.
Yeah.
Now she can then claim an additional allowance, the residence allowance, which she couldn't do before if she was not married. So her inheritance tax scenario would also improve significantly, because she's not got £1 million to play with rather than 325,000 on her own. So just something like that, and she can direct the wealth of her share of the property to her nieces, nephews, or family and loved ones, rather than it's just a complete mess. So she passed away first. Gerard would get all of it, and Gerard doesn't have to honor her wishes, and he's got extra money, extra wealth, which may not be in line with what Julie might have wanted. All right, so something that's actually quite simple, but it's really profound. Blended families have a lot of planning to do, a lot of conversations to have. So getting married is actually something that we're probably going to talk about. But just severing a tenancy in a strategic way and having a goodwill, which will come on again probably a bit later on, does make a big difference.
Okay, thank you. So Gerald, did you say it, or Gerard? Gerard.
I know it's easy to forget, I guess. Yeah.
So he made basically a pretty big mistake by not having a will in place.
Yeah.
For his child. So yeah, that is quite common though, isn't it?
It is quite common, because people just don't know. And then they've been together for donkey's years, they own assets together, and they just think, it's okay, it will work out. But then they realize, actually, no, it won't. When you highlight it, especially when there's other assets from, parents or inheritances, that you don't necessarily want that to go to another family, or your children lose out because of poor planning.
But then if he didn't want to get married, he could still create a will and put that in the will that he'd want his son to inherit.
Yes. Just from inheritance tax, it won't work out very well for him unless you get some other mitigating vehicle, like a life insurance policy or something. But at least the wealth would be directed and protected in the right way.
Okay. All right. Thank you. So as we've already touched on wills, how would it work for single and married couples and widows?
Yeah. So let's start with singles. So we covered one with obviously Gerard and Julie. They're technically single; they're not married. So they'd have to have individual wills for their wealth. And if they own assets together, they'd have to strategically, own it or sever the tenancy, or what we call it now, just equalize the estate between them. If they're not got no assets that they're shared with anybody else in their own name, Then it depends on their personal circumstances. If they have children, or foster children or stepchildren, then there's something they can do to increase the amount of inheritance tax allowance. If they don't have that or don't want that or don't really care for it, but they do want to make gifts to nieces, nephews, loved ones, then having a strategic will in place, ideally with a trust, a discretionary flexible trust in the will, so they can direct that wealth in the right way rather than making specific gifts, which I've always think is quite dangerous because you just don't know what the future holds. With a will, the residues is put in the trust. At least you can direct that amount to your loved ones. And then the trustees can manage that part. And then anything that exceeds that, then the executors can also manage that to whoever you want it to go to. So that would probably be for someone who's single. If they're in a relationship, they're joint and they own assets together, it's a different conversation. If they're married, as I mentioned before, they can do additional planning. So the wills normally we have in those type of trusts will be, different professionals write in different ways. I don't really, I think advocate's the wrong word, but I prefer discretionary flexible trusts initially, and then something called a life interest or immediate post-death interest trust for married couples, because married couples can gift infinitum to each other, and that type of trust, an immediate post-death interest trust, it belongs to their estate. So if you can give to someone infinitum free of inheritance tax, that's the perfect type of trust to utilize. And there's benefits of protection, for their half of the property, living in the other half of the property, making gifts, pass it down to children, in both types of trust scenarios. It's very powerful. So, and then from an inheritance tax perspective, which is what the topic is, what we're talking about, again, you're maximizing allowances up to £1 million. Now, with widows or widowers, a lot of people don't realize that they can still claim the allowances. They're still married, a widow or widower. So you can still claim the allowance of your deceased spouse. So it's important that the will's still drafted with the mindset that there's £1 million to play with rather than just £500,000 or 325,000 if there's no children. So always, it's a good point to raise, because a lot of people just didn't realize that. Doesn't realize that at all. So it's important to kind of bring that to the fore.
Thank you.
And then you can plan around that. Everyone has different scenarios, so there'll be nuances and changes accordingly. But from an inheritance tax busting, estate planning perspective, really, really important.
Okay, thank you. So just to
actually, it just reminded me of something. Disabled or vulnerable persons. In the lifetime, if you've got a family member who needs to receive a lot of wealth, but you don't trust them to manage that wealth by themselves, using Vulnerable Persons Trust Section 89 of the Inheritance Tax Act is also a very powerful inheritance tax busting way, because even though it's a discretionary trust and it works exactly how a discretionary trust should work, the tax regime is completely different, and it's treated as if you're making a gift directly to the person. So it just needs to survive 7 years. So you could make a gift in your lifetime to your child, unlimited, whereas regular discretionary trust is capped at 325,000, and it's taxed. But because the tax regime is called a relevant property trust, for those who want the technicality, doesn't apply for those who are deemed as vulnerable, it's treated as a potentially exempt transfer. You can gift as much as you like. It only becomes a chargeable transfer if they die within 7 years of the gift. So that's a really powerful way of making a large gift in your lifetime, without having to worry about the 7 year. Well, the 7 year rule still applies, but ideally the person you're gifting to is relatively young, and also you're not got this 20% tax to consider to pay. The trustees have to pay, but the trust is still discretionary. The trust still works how it should, but the tax regime is just different. It's very, very powerful. So something else to consider as well, I'd say simple, because some advisors may not be aware. That's just the reality of it. It is quite a niche area. So just what I said, some people are just not even aware of that. There are other caveats, but ultimately it's all in the advantage of the beneficiary ultimately. So something definitely to consider.
Thank you.
Without a doubt, yeah.
Thank you. And also just to add on as well, making gifts have been a really popular topic around a way of reducing inheritance tax,
Yeah.
because that means you're reducing the size of your estate. Would you like to touch up a bit on that part?
Well, just lifetime gifting. Yeah, I mean, unfortunately, people kind of come onto that conversation in later years when they realize, oh, well, we've got a problem. And it can be very frustrating from the advisor point of view, and also for the client, because it's like, certain scenarios they may not want to entertain.
Yeah.
So for example, life insurance is far more expensive when you're a lot older.
Yeah.
And one inheritance tax busting tip was, like whole of life assurance is a really good thing, in my opinion. Number one, because you're from an inheritance tax point of view, you can mitigate against that specifically. Potentially, I say potentially, the beneficiaries or the children could pay for it. Or if you pay for it at your income, then there's other exemptions that you can qualify for to reduce your inheritance tax allowances. So it's a good tool. So that's the other one thing. But just in general, making gifts, if they're cash rich, maybe not a problem if they don't need it to survive from a pension perspective. If they're asset rich, it's really challenging. So unless they want to downsize and then receive the funds and then just give the funds away, but you can't transfer property to a loved one because that's not inheritance tax efficient. If you're still living in the property, it's just not going to work.
Okay.
Whether you give it directly or put it in a trust, it doesn't matter. You're living in the property, making a gift, putting your child's name on the property will not reduce your inheritance tax allowance. If you're living in the property, you're still benefiting. And even if you give a lump sum money away, if you're still benefiting from the cash that you gave away or the asset, the picture, or the painting, or whatever it is, you're still benefiting from it. You're going to get an income tax on it instead. So you need the planning. You need the planning. Gifting can be quite technical, can be a little bit frustrating. Sometimes you think it's straightforward, but other times it's not. So we've got to look at the bigger picture.
Okay.
And I had a client situation recently as well where, single chap, £1 million property in London. Children are in Europe, I think Spain or France, something like that. Now he's like, well, why can't I just give to the children? And I'm like, well, you can, but it's not going to do anything for your inheritance tax. He goes, well, why? I said, well, you're living there. I said, okay. So at least want to pay rent. He didn't want to do that because where he lives is an expensive area. Life insurance for the savings that he has is for his income, is for his livelihood. He has nothing else except for his house and his savings, and he wasn't prepared to do either. So, well, downsize. But if you give it to your children, you're going to put it in a trust because it could affect. They have a different regime in Europe, like forced heirship. It's not testamentary freedom that we have over here. So it could affect them receiving a lump sum during their lifetime for their estate taxes. And over there, it's immediate. You inherit their debt and everything, depending on the country.
Yeah.
Or they nominate it, or they just give it away. It's very complicated depending on what country they're in. So putting it in trust, they don't own it, they can't take it or tax it, and you're protecting the children. So those are the things that it starts to get a little bit complicated. So everyone's story is different. Everyone has a different scenario. So gifting can be problematic. Charities, probably your safest bet, maybe. But you need to have the disposable income to do that.
But with
either
that,
a lifetime or during death.
But with that, you wouldn't be able to create generational wealth with your
Exactly.
gifting to charities.
Just going straight to charity. So it's like, well, if generational wealth is not the top of your priority, it could potentially work out. Okay. And plus, you have to give all your wealth to charity. You might have a percentage.
Yeah. Okay.
Yeah. And the rate of inheritance tax is lower. I think it's like 36% if you give more than 10% of your estate away to charity.
Okay.
And then any direct gifts to charity is exempt. So yeah, it could be a worthwhile thing.
Okay, thank you. And also just to touch up on exemptions.
Yeah. So there's different ones.
Mm-hmm.
I won't get into all the technicalities of it, but if you have an income, like a pension income, or you're still working, or whatever it might be, and you can live on a set amount, and you got a payment that you're making monthly, either you're making a gift or something like that, and it's not interfering with your lifestyle, then there's some exemptions. It's not deemed as a transfer of wealth. Basically, they won't take into account. So that could be potentially useful. There's something called family maintenance. So um, you could maybe plan if you're doing private schooling and you've got
Mm-hmm.
your receipts and bills, or even currently keep them, because it's family maintenance, right? Up to age 25 if it's university education. Um, it could cover that, or whether it's children or people who you're looking after as your child, or older family members potentially. Um, Again, you need to get specific advice on this. This is very generic, and I could be making a mistake, so
Yeah.
don't take my word as gospel here if you listen to me. It's just to put seeds of thought in your mind. Um, and then you got gifts like weddings. So
Mm.
children, I think so, from last check, it's like £5,000. Grandchildren, you can claim an allowance on that amount or amounts. So and then just a gift in general to someone. And then you got £3,000 every year can be just gifted free of inheritance tax. People are not really utilizing that. So pre and post April, you can make a gift, and if you haven't done it before, you can claim for the previous year. So it's up to £6,000 on the first gift, which is very powerful. It
Mm.
might not sound like a lot, but it does add up over time if you have a
Yeah.
lot of cash.
Mm-hmm.
Then you got like minimal gifts for birthdays and Christmas, maybe £250 a year.
Mm-hmm.
So all those little things do add up. It can make a big difference with planning, you know. So yeah, those are kind of the exemptions that we're looking at, from that can be utilized. I'm sure there are others, but these are the ones that just on the top of my head that can
Yeah.
potentially be utilized as a potential, you know, inheritance tax busting tip.
Okay, thank
So
you.
it's something to explore or talk more about.
Yeah, yeah, definitely.
The other thing, which we'll probably cover another time, but if you've got life insurance, make sure it's in trust, because that will reduce your estates.
Mm-hmm.
Whether it's directly with a life insurance company, or a specific bespoke trust, get it done in trust, because that will definitely reduce your estate. Family income benefit, life insurance, term assurance, whole of life insurance. Try and get it in trust. Get some advice around it so you can choose the right type of trustees. Um, Make sure you're not selecting an absolute trust, or you're told. I think I had one client, they were told, because it was a joint policy, first death, so joint life, first death, not second death,
Mm-hmm.
and they were told that you can get put it in trust as a joint policy,
Mm-hmm.
and they believe it because it was outside of their estate because it's in trust. But when you read the small print, the trust is set up within 30 days of the first death event for the surviving spouse. So, but it pays out. So, like, that's not an inheritance tax busting scenario. That's not going to
Mm.
help you, and because we don't know who's the first person to pass away. It's so a trust is set up, but only on the person who survives. That really may
Mm.
not be of any use to you. So, having a trust in play initially, having your own independent insurance policy. Not, I don't like joint policies, but I'm not saying they're wrong. But for inheritance tax purposes, they can be really problematic. Um, get the right advice, and make sure you're not doing something completely drastically
Yeah,
trying to shoot yourself in the foot.
thank you. And also, thank you for that. Really appreciate it. It's very detailed.
Okay.
And also just to touch upon a bit on family abroad, you did mention it a bit earlier.
Family abroad.
Yes.
Yeah, I mean, yeah, it's a whole world. But you got to make sure, and most people don't understand if they are going to be like non-resident or non-domiciled.
Mm.
If they have family that are abroad, um, then and they want to make gifts, you know, my school of thought is the left hand that does the left hand, the right hand does it the right hand. So get a will in place in the jurisdiction where the family is if you have assets abroad, and keep the assets in the UK there.
Mm-hmm.
If you don't, then the rules for the UK is it's worldwide assets for inheritance tax.
Mhm.
So if there's no planning whatsoever, then they have to entertain every asset you own in every
In
jurisdiction
different
around the world,
countries,
and
yeah.
that's going to be very timely, potentially very costly,
Mhm.
frustrating for the loved ones who want to receive their asset, whether it's
Mhm.
cash or land or whatnot. Expensive lawyers who understand the English jurisdiction and the jurisdiction of where the family may be
Yeah.
abroad, because every country is different. Getting the court to sign off on it,
Slot.
if the private law is not necessarily interpreted the
Mhm.
right way, it can be very problematic. So you just want to deal with it in your lifetime. Keep it simple and civil, and then you know where you stand with that.
Yeah.
So from an inheritance tax, maybe the main point is that worldwide assets will be considered if you don't do anything about it
Mhm. Okay.
in your lifetime.
Thank you so much. That's very in detailed.
That's cool. It's not a problem. I hope everyone who listens, got a lot of value out of this.
Oh, I did forget to ask one question actually.
Okay. Yeah.
Just to push it back to insurance, whole of life and term insurance versus
Yeah,
term
we kind of covered
insurance.
it. So, whole of life is whole of life.
Yeah.
I think the general rule of insurance: the younger you are and the healthier you are, the cheaper it's going to be.
Mm-hmm.
So the sooner you know about these things, the sooner you can take action. You could get a £500,000 or £1 million policy at a young age, and for you to actually save that money or even invest it in your lifetime and get £1 million or £500,000, it's going to take some doing. And it's guaranteed to pay out at some point in your death.
Yeah.
A term assurance, if it's like to age 70, and you live one day after age 70, that ain't paying out.
Mm.
So you like all that money is kind of technically gone down the drain. Loved ones are missing out. Mortgages are not paid off for whatever it might be. So you got to, and then to renew it later in life would be far, far, far more expensive.
Mm.
So we just kind of go with what's on the team. We listen to what we're being told, but we don't maybe challenge the knowledge because we don't know about it. The other thing about in life insurance, I think you're talking about, we get a lot of questions about this infinite banking. Something that's in America, like loaning against
Life
your life insurance if you put it in trust. I wish that was possible over here, but from my understanding, that's not, because the life insurance policies, in the main, do not come as investment vehicles.
Mm-hmm.
So they're not going to accumulate funds that you can actually loan against, like a bank. So yeah, when someone passes away and that it pays out into a trust, trustees will have the power to make loans if it's the right type of trust that's set up, because not all trusts have to give trustees the power to do that. So you got to read the small print, and then you can make loans against the funds if the trustees want to do that. But per se, from what you've seen on YouTube and Instagram and all this kind of stuff of life insurance in trust, do what the rich people do in America, that may not necessarily be working like that over here. So just be very careful.
Well, thank you so much, Richard.
No, that's cool.
Very, very insightful, as usual, as always. Yeah, so I think that's the podcast has come to an end.
Okay.
Thank you for watching.
We're missing something though. We've got a special launch. Don't know if I'm going to mention that.
Yes.
Quite excited.
So we have an ebook coming out about trusts. If you know anyone, or even if you yourself want to know a bit more about trusts, we are going to release that this week, tomorrow.
Yeah.
Hopefully. Well, it should be coming out tomorrow. So yeah, if you'd really want to know a bit more about trusts or the different types of trusts,
I say a lot more about trusts. We haven't missed anything out here. It's a detailed book.
Yeah, it's quite detailed.
And we got it on a very special offer, so you can't miss out on it.
Yes. So and it's for a limited time. So we will post it tomorrow, so you'll be able to see it as well.
Yes. So
thank you.
Another addition to your education, shall we say?
Yes. It's all for you at the end of the day.
Yeah, definitely.
All right. Well, thank you so much, Richard. And thank you for watching.
Thanks all. Cheers.
Bye.
Bye-bye.